Okay, hello everyone. Can you hear me? I hope this goes well. Okay, how about you? Cool. Okay. Today we'll cover chapter 20, Incremental Analysis. Actually, we were supposed to meet today in classroom, but you know that there was a shooting and wildfire, so we could not meet on the class. So to make up the pace of our coverage of the class, so I record this video and I have uploaded. So please go ahead and watch it and let me know if you have any more questions. How can I help you better? So, okay, today we will talk about incremental analysis, chapter 20. From chapter 18 and 19, we learned about how to use CVP, cost, volume, and the price analysis to determine how much we want to make a production, what price we want to assign, and how much cost we incur to make a break even and a certain level of margin, certain level of net income. So today we will then talk about incremental analysis, which is that when we know how to assign, how to analyze the net income level, the volume, and the cost, then we may want to use that information we already produced using what we learned so far, which option, which kind of the choice we want to make. We have more than one choice. So far, we assume that we only want to know about what would be the scenario we want to choose optimal level to produce. And now, we'll talk about which would be better option between two or more than two, maybe three or four alternatives. So this is what we talk about today. Okay, there are 6 learning objectives. First, we want to describe how management decision-making process goes and the incremental analysis, how we use it. And actually, the learning objective 2 to 6, the 5 different scenarios, how we can apply what we learned from the learning objective first one. Second, we want to talk about how we can use incremental analysis using analyze the relevant cost, whether we want to accept or an order at a special price. And third, we're talking about how to analyze the relevant cost, make or buy decision, which one is better, make by ourselves or buy from somebody else, like outsourcing some production. And fourth, analyze the relevant costs in determining whether to sell or process material further, which means that do we want to sell something at this stage of a material, or we want to make a better product, and maybe which one is better for our company to make more profit. And fifth, we will talk about the relevant cost analyzation to be considering repairing, retaining, and replacing equipment, which means that if you have some used machine or car, vehicle, some kind of equipment, whether we want to repair it and keep using it, or do we want to buy a new one and selling the old one, and which one is better for our company's profit. And last, and we want to analyze relevant costs in deciding whether to eliminate an unprofitable segment of product. So do we want to keep the segment, or do we want to just eliminate it and sell it to somebody else? So from the learning 2 to 6, we will learn how to analyze and apply while we use the incremental analysis. Okay, the launch at first is talking about how we make the decision and how we can use management accounting information to make the decision process in the management of company. Usually, they're not a set of pattern we will follow all the time, but at least we can identify some kind of steps we want to follow when we make a decision in managing a company. First, what we need to do, no matter what, we want to identify the problem, and we also assign responsibility. So no matter what problem happens, we want to know what is the problem we are facing, and then we need to assign who is taking care of that problem. That's the first step. And the second step is we need to determine and evaluate the possible course of action. So we want to know about what kind of actions, what kind of alternative, what kind of choices we have. We need to choose among the choices what we can face. And then we need to make a decision, and then we need to review the results of the decision, which one is better. We made a wrong or right decision, so we need to evaluate what we did. So incremental analysis is related to step 2 to step 4. So we'll use all the information, mostly quantitative information. So whether we want to know about this would be make more revenue, less cost, make our company more profitable or not. So we compare different scenarios, which one is better for our company. So the decision-making process has 4 steps, as I talked over here. We need to know what's the problem, and we need to decide who's taking care of that issue. But what's more important, what we will learn about today, is how we can determine and evaluate what action, what choices we have, and then we make a decision, and then we evaluate our decision process. And regarding the decision process, we consider both financial and non-financial information, which is financial is usually we'll talk about using numbers, how can we measure the cost, revenue, and the profitability, efficiency. And non-financial information is, which is not related directly to the profitability of the company, but we can talk about whether it have impact on the employee turnover, environment, corporate social responsibility, other things that might be related to stakeholders. But today we will mostly focus on the financial information because that might be the thing we can calculate easily, and then we can just face in the situation of incremental analysis. So incremental analysis, talking about things, whether we want to know about alternative actions, so different choices what we can face, which one is better for our company. So alternative means that we try to see what's the difference we make if we choose option A or option B, option C, or other things. But we'll talk about which provide difference to our company's outcome. So there could be some different alternatives which make changes in the alternative course of action. So the process of identifying the financial data that change under alternative courses of action is talking about incremental analysis. And also, in other words, we call incremental analysis as differential analysis because the analysis focuses on the differences among different choices we face. Sometimes they are related to the both cost and revenues, sometimes only revenues. In the other cases, only costs are related, they changes of different actions. So the question will give you the information what changes by choosing each option. We'll talk about which one is better for our company. For example, how the incremental analysis works. This is a basic approach in incremental analysis. So we want to know what option do we have first. In this case, we have alternative A and B, and we compare in each case is how our net income increases or decreases regarding revenue, cost, and the net income in total. So if we choose alternative A, it will provide us 125,000 revenues. If we choose B, and it will give 110 only. So alternative A provides us more, 15,000 more net income. So if we compare A and B regarding the revenue section only, alternative A provide 15,000 more, so alternative B provide 15,000 less than alternative A. And regarding the cost section only, alternative A make us to cost 100,000, while the alternative B make us 80,000 only cost. So if we choose alternative B, we can make 20 more net income because we can reduce our costs, we can save some. In the end, the net income from alternative A is 25,000, and to the B is 30,000. So net income difference between A and B is that B make 5,000 more. This is a basic kind of concept of incremental analysis. Just think about the options we face in kind of situation, and then compare what cost and what revenue changes, how much we make the difference in each section, and how much we save, how much we cost more, and which one is better, which one is more profitable. So focus on the changes we can make by choosing one option than the other, and then compare the revenue and cost incurred in each scenario, and then compare what's the difference. And then we want to calculate what would be the net income, the effect in total and changes in its different scenarios. And that is what we want to talk about today. So the three concepts of the cost we think about, we use when we perform the incremental analysis. First one is relevant cost. Relevant cost means that the cost and the revenue that changes across the different choices or options. And often it means that choosing one option also provide a company must give up the opportunity to benefit from some other courses of action the other scenario, that is also known as opportunity cost. If you have chance to took maybe basic microecon, then you maybe already know what's opportunity cost. Opportunity cost means that something already gave up because we choose different options. And some cost means that already been incurred, which already happened, so we cannot change it. What already happened, we cannot avoid it anymore. So in the present or the future, we don't care about it anymore. So what we really focus on when we perform the incremental analysis is that relevant cost. And sometimes we need to care about opportunity cost. And some cost is something, maybe the question provides information, but we don't want to care about it, so we ignore about the some cost. So the first step, what we need to do when we solve the problem, we approach and perform the incremental analysis, is that we need to know and classify all the costs relevant to it, relevant costs, opportunity costs, and the sum costs. Sometimes there could be some changes involved that contrary to intuition. So we need to know which one is a fixed cost change and which one is variable cost change. We need to analyze it step by step. So when you need to solve the problem, be calm and read the question carefully. Take your time to analyze the information. And then if you understand what's going on, then solving the problem is not that hard. But what matters most is that you need to understand what's the change, what is relevant cost, what is opportunity cost, what is sum cost. So try to interpret the question carefully, and then just doing the calculation part is not that hard. It's quite simple. There are 5 types of decision involving adopting incremental analysis we use. So that was the learning objective 2 to 6. First one, we need to decide whether we accept an order at a special price or not. Second, we need to determine whether we want to make or buy components, parts, or finished product. Third, we want to sell the product as itself at this stage or process further in a different stage. And fourth, repair, retain, and replace equipment. Fifth one is eliminate unprofitable business segment product or keep the business segment if we can. So the question, so what is it? Incremental analysis is a process of identifying the finished data. What would be that one? Think about it. So whenever you need, just pause this video and then think about it and solve it later. So because I don't take any question and I want to make the recording time short, so I don't pause much. But if you need, just pause it and read the question, think about it, and then you can resume the playing, okay? In this question, what would be the answer? What do you think? What is the incremental analysis mean? I told you that incremental analysis is something we want to think about what different we can bring if we choose different scenarios of option. So if we want to know about differences, what would be the thing we want to know? We want to know about what changes under different courses of action. So the answer should be B. So incremental analysis is the process of identifying the financial data, which is more quantitative parts, that the change under alternative course of action. What changes by choosing different course of action is relevant cost, and that is the cost we really focus when we apply the incremental analysis in the scenarios. Make sense? Okay, then maybe you need maybe 3 or 5 minutes to read the question, and so pause the video and read it, and then go ahead, and you may want to resume later. You can go ahead and maybe pause 3 or 5 minutes, so as much as you need, and then read the question, and then we'll go ahead together. But in the video recording, I will pause. Okay, we can go together now. So I assume that you already read the question. You pause a few minutes. ONT Corporation is comparing 2 different options. The company currently follows option 1, which revenues of $80,000 per year, maintenance expenses of $5,000 per year, and operating expense of $38,000 per year. Option 2 provides revenue of $80,000 per year, maintenance expense of $12,000 per year, and operating expense of $32,000 per year. Option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of $22,000. If option 2 is chosen, it will free up sources that will increase revenue by 3,000. To complete the following table to show the change in income from choosing option 2 versus option 1, and designate any sunk cost with an S. Okay, so there's a table and we need to fill it out. So what we want to do is to make the fill one by one. So regarding the revenue, there is no difference between choosing option 1 and option 2. Why? Because both option 1 and option 2 provide you 80,000 revenue. So we can fill it 80,000 for revenue for option 1, option 2 same. There's no increase or decrease regarding net income by revenue parts by choosing any option 1 or 2. Second, regarding the maintenance expense, if we choose option 1, it costs 5,000 per year. If we choose option 2, it costs 12,000. So if we choose option 2, there will be 7,000 decrease in net income because option 2 requires us to pay 7,000 more of maintenance expense. And regarding operating expense, how much? If we choose option 1, it costs us 38,000, while option 2 provides us to 32,000 operating expense. So we can make 6,000 more net income if we choose option 2 compared to option 1. Regarding equipment upgrade, only option 1 requires us to use 22,000 equipment upgrade, but it has already happened, which means that we cannot change it. It does not matter in the future of the present. So no matter there's a difference, but it is a sunk cost. So even though option 1 and option 2 has 22,000 difference, we don't care about it. So it will not affect our net income. So the decrease or increase in our net income will be zero. It doesn't matter how much difference will be because it's already happened. It's not relevant cost. It's sunk cost, so we don't care about it. Now, regarding the opportunity cost, if we choose option 3, it only provides us 3,000 more resources, increased revenue, which means that if we keep using option 1, there is more 3,000 opportunity cost, which is given up by choosing option 1. So if we choose option 2, our net income will be increased 3,000 more. In the end, if we choose option 2, in total, the net income will be increased by 2,000. So choosing option 2 might be more profitable to the company. So this is the kind of things we want to do today through all the different 5 scenarios. Okay, the first scenario, we want to apply the incremental analysis in the scenarios of accepting an order at special price or not. And what we need to do is analyze only the relevant costs. And sometimes when we need to care about opportunity costs, but also we don't want to care about the sunk cost because it has already happened. It does not change our future or present profitability. So even though the information is over there, we need to classify whether it's a sunk cost or we ignore it. Okay, accept an order at a special price. If we want to obtain additional business by making a major price concession to a specific customer, which means that if somebody comes to you and they say that, okay, I'll pay you this much if you provide me this kind of product at this price. So we want to know whether accepting this order is better for our company or not. So this is illustration. So what we need to in this scenario, so I will give you guys 3 minutes to read it and pause it, and then we'll go together. So please pause. Okay, I think you already paused and I assume that you read the question. We can go over together. Some milk company produces 100,000 smoothie blenders per month, which is 80% of plant capacity, which means that this company has 20% of plant capacity, which is not used yet, so we can produce more without that much fixed cost. And the variable manufacturing costs are $8 per unit. Fixed manufacturing costs are 400,000 or $4 per unit because they produce 100,000. The blenders are normally sold directly to retailers at $20 each. Sunbelt has an offer from Kensington Company, a foreign wholesaler, to purchase an additional 1,000 blender at $11 per unit. Acceptance of the offer would not affect the number of sales of the product, which means that it does not make any influence on our normal operations. So the market is independent. So we don't need to care about more complex scenarios. So, and the additional units can be manufactured without increasing plant capacity, which means that we don't need to care about the fixed cost because we don't need to make additional units regarding the fixed cost and the plant capacity. So we have 20%, which is not used yet. In this case, we need to only care about the variable cost we need to incur to make it. Okay, now we can apply the incremental analysis in this scenario. First one, how much revenue we can make if we reject the order, accept the order. If we reject this order, we don't make any more extra money, so it will be 0. But if we accept it, we make 22,000. So net income will be increased by accepting this order, 22,000 by in the portion of revenue. How about the cost section? So there is no change in the fixed cost. We will make only variable cost changes, which is $8 per unit. So we got order of 2,000 units. So it will provide us 16,000 in the cost increase. So, which means that by accepting this order, we make 6,000 more profit. If somebody thinks that we may incur $4 more fixed cost and 2,000 units, so 8,000 more fixed cost, we may think that by accepting this, we lose 2,000 more money. But it is wrong because the question already told us that before. Here, there is no change. Acceptance of the offer would not affect the normal sales, and the additional unit can be manufactured without increasing the plant capacity. So we compare two scenarios by accepting it or not, and then it will give us 6,000 more profit. So we only care about the variable cost. What we need to do is that we need to accept this order to make more profit. But in reality, maybe we need to care about other things. Maybe there could be other things regarding the environment. Maybe we may think about other things. Maybe sometimes the producing new product may have impact on our normal operation, maybe normal market, then we need to care about it. But in this scenario, we assume that the market for two products are independent and it will not change anything except the variable cost. So in this case, it might be better for our company, which is more profitable, 6,000 more by accepting this order. Okay, now I'll give you guys 5 minutes to solve this problem. Just pause this question over here, the video, and then do it, and we'll go over together. Okay, I assume that you guys already read the question and solve the question by yourself. Maybe if you need more than 5 minutes, just go ahead, practice it, because by practicing, you will reduce your time to solving the problem. There will not be any problem just using more time in the first stage. Okay, cup company incurs cost of $28 per unit, which is $80 of variable cost and $10 fixed cost. You make $8 per unit cost in total to make a product that normally sells for $42. The foreign wholesalers offers to buy 5,000 units at $25 each, but will incur additional shipping costs of $1 per unit. To meet the increase, the decrease in net income, Cup will realize by accepting their special order, assuming Cup has excess operating capacity, which means that we don't need to incur any more fixed costs. We only care about the cost. Happens over here. Should Cup company accept the special order? Okay, if we reject it, there will not be any more revenue change, so it will be 0 change. If we also cost will be 0, so net income will be 0 change. How about if we accept it? If we accept it, we can sell each product at 25 and we will sell 5,000. So it will give us 125,000 revenue. At the same time, we will pay $18 variable cost and $1 shipping cost. So $19 shipping cost times 5,000 units. So provide us 95,000 extra cost if we accept this order. So it will increase our net income 30,000 more. So do we need to accept it or not? The answer should be we need to accept it. Why? because by accepting this order, our revenue increases 125, and our cost increases only 95, 30. 30,000 of net income will be increased by accepting this order. So by accepting this order, our company will be more profitable. So we need to accept this order. Isn't it hard, right? Okay, then the second scenario, linear check 3. So we will want to apply our relevant cost analysis, which means that we want to apply our increment analysis in the scenario of make or buy decision. We need to make something by ourselves or outsource something, and we need to buy from somebody else. Okay, I'll also give you guys 3 minutes to read the question, and then we'll go over it together. Pause it over here and then try it by yourself, and then resume it, and we'll go together. Okay, now we can go together. So Baron Company incurs the following annual cost in producing 25,000 ignition switches for motor scooters. Instead of making its own switch, Baron Company might purchase the ignition switches at a price of 8,000 per unit. What should management do? Okay, think about it. This table shows us that the direct material is 50,000, direct labor 75,000. So variable manufacturing overhead 40,000, fixed manufacturing overhead 6,000. The total manufacturing cost is 2,000 to 5,000. They make 25,000 units, so the total cost per unit is 9,000. If we buy something at $8 per unit, intuitively maybe it might be better to buy it. Why? Because we need to incur $9 to make it, we can buy it at $8. But would it be true or not? We need to buy it or make it. Maybe $8 is less to cost per product, ignition switches. We may want to buy it instead of making it, incur $9. Is it true? Maybe not. So what we want to do is that we need to apply the increment analysis in this situation to see which one is better, make or buy. Okay, we can use a table. Direct material, if we buy, we don't incur any cost. Direct labor, same. So we can save 50,000 by direct material and direct labor if we buy it instead of making it. So net income will increase that much. Also, same for variable manufacturing costs. But how about manufacturing fixed costs? When we compare 9 and 8, we thought that we can reduce all the costs we incur when we buy it. But if we need to incur 50,000 fixed costs, even though we buy it, we cannot reduce the full amount of fixed costs. It only increase our net income 10,000. So if we purchase it, we pay the price. So in the end, when we buy, actually, our net income will be decreased 25,000. So total manufacturing cost is $1 higher per unit than purchase price. So which means that making the ignition switch by ourselves make us better profit. Because the thing is that we need to care about fixed manufacturing costs. We can reduce our fixed manufacturing costs more by buying the ignition switch rather than making it. Maybe it might be more profitable to buy it. But in this case, buying option only reduce the manufacturing cost regarding fixed portion only 10,000. So actually it doesn't make our company more profitable to choose the buy option. So making option is better in this case. So I told you that when we need to care about the increment analysis, we need to care about relevant cost, which changes regarding the financial data. Also, we need to care about opportunity cost, which is protection benefit that may be obtained from following a different alternative option, which we did not choose. And also, when we think about make or buy decision, so far in this question, we only care about financial quantitative data, but also we need to care about non-financial data, non-financial information, which is that whether this is better for our company and the area, or maybe this is better too for our company's employee, the environment. So we need to care about ethics together. So opportunity cost. So assume that through the buying the switches, Baron Company can use related product capacity to generate additional income, 38,000 from producing a different product. The lost income is additional cost to continue to make the switches in the make or buy decision. In this case, we have one more information, which is that there could be $38,000 of opportunity cost, and we need to care about together. So, making a buy, we already know how much it will provide as a total annual cost. But if there is some opportunity cost, in that case, we need to care about it too. So, if we buy something, we can use that facility to make other products, so we can make 38,000. If we make the ignition switch, we will give up that opportunity cost. So we need to care about that opportunity cost at the same time. In that case, the total cost to choose making option increases by 38,000, which is given up by choosing making option. In that case, actually, buying option will provide us more profitability by 13,000 more. So in that case, buying option is better and more profitable for our company. So question, making or buy decision. So in a make or buy decision, relevant coster, all of the above. Why? Because we want to care about how much manufacturing cost we can save by making or buying. Also purchasing price of the unit, and also we need to care about opportunity cost. There is any opportunity cost. Got it? So I will give you guys also 5 minutes to read the question and do it. If you need more time, just use more time as much as you need. Pause over here, and then we'll resume, and we'll go over together. Cool. Wanting that company must decide whether to make or buy some of its components for the applicant appliance it produces. The cost of processing 166,000 electrical costs for its appliances are as follows: direct material 90,000, variable overhead 32,000, direct labor 20,000, fixed overhead 24,000. Instead of making the electric cost at an average cost per unit as $1 because they produce 166,000 units, the company has an opportunity to buy the cores at 0.9 per unit. If the company purchases the cores of our variable cost, then 1/4 the fixed cost will be eliminated. So now about how much 6,000 of fixed overhead cost will be reduced. So now the question is A, prepare an incremental analysis showing whether the company should make or buy the electric cost. B, will your answer be different if the released productive capacity will generate additional income of 5,000? Okay, let's do it. A, prepare an incremental analysis of showing whether the company should make or buy the electric cost. Now we already have the information regarding making from the previous page. We can just use the number from the previous page. Which one we need to fill out now is regarding buying option. So what option do we have? If we buy, we said that all the variable costs will be eliminated. So we will not pay any regarding direct material, direct labor, variable manufacturing costs. And at the same time, it says that 1/4 of it, so 6,000 of 24,000 of fixed manufacturing costs will be eliminated. So we will only pay 18,000. And regarding the purchase price is 149,400 because we pay $0.9 per unit and we buy 166,000. So by multiplying 166,000 times 0.9, we will get 149,400. So the total cost will be 167 and 4,000. So if we compare the net income because it increases in both scenarios, making or buying, so it will give us 1,400 less net income. So in this case, the wanted company will incur 1,400 of additional cost if they buy the electrical rather than making them. So in this case, the company should keep making it because they will incur less cost, which means that they will have more net income. in the case of making instead of buying. Now, how about if they have additional 5,000, which is opportunity cost? If they buy it, in that case, if we take care of 5,000 more in the opportunity cost in the making scenario, so in this scenario, actually, buying will be better because net income in the scenario, in the case of buying the course instead of making, will be increased by 3,600. So the decision we make might differ by how much opportunity cost we need to care about. Make sense? Okay. Number 4, the third scenario that we want to apply the incremental analysis is whether we want to determine to sell or process the material further. So in some cases, we may have option to sell the product at a given point in production in the process material. And sometimes we may want to process further and sell the product at a higher price. So we want to know about which one is better for our company, and the decision rule is same as before. So processing further make more revenue than the revenue we make extra by processing further exceed the incremental processing cost. So if we make more net income by processing the product further, then we want to do it. If it's not the case, we just want to sell the product at a given point in production now. So the single product cases. So I'll give you 5 minutes to read it and we go together. Just pause the recording now and read it. Maybe 3 minutes you need, and then as much as you need, and then go ahead and then resume. Okay, I'll assume that you already read it. With masters in compression make tables, the cost to manufacture an unfinished table is $35. The selling price per unfinished unit is $50. Wood Masters has an unused capacity that can use finished table and sell them at $6 per unit. For the finished table, direct material will increase $2, and direct labor will increase $4. Their manufacturing overhead cost will increase by 2.4, which is 60% direct labor. Now, no increase in anticipated is in fixed manufacturing overhead. So they sell the table at unfinished level at 35, but if they finish it, they can make 50. So they can make 50 more by that one at the same time, but they can incur more cost. So we want to compare that one. By now, manufacturing unfinished table, they make 35 per unit. That's the cost to make $15 direct material, direct labor 10, variable manufacturing overhead 6, and also fixed manufacturing overhead 4. So we will compare which one is better. The incremental analysis is per unit basis is follow. If they sell unfinished, they make 50, but they incur $35 of cost, so their net income will be 15. If they process it further, they can sell it 60 by the crushing, but they increase $2 of direct material, so with 17. Direct labor will be $4 increase, so with 14. The variable manufacturing overhead will be 2.4, so 8.4 will be the variable manufacturing overhead, and there will not be any change in fixed manufacturing overhead. So total cost will be 43.4, and the sales unit will be increased 10. So the net income per unit will be 16.6. So if we compare in each scenario in each section, so sales price will be increased 10, while the cost will be increased 2 for 2.4. So the total cost will be increased 8.4, but the sales price revenue will increase by 10 by each unit. So there will be $1.6 increase in net income by each price. What do they do in this scenario is that to make the company more profitable, they need to process further this table. Make sense? In some cases, there are more than one product we can take care about. For example, in this scenario, if we buy the raw meal from the farm and we can process it, and then we can make different products. First, we can make a common process, and we want to make cream or skim milk. We can split up the point, which level, and then we may want further cream, more processing. We can make cottage cottage cheese, and we can process further skim milk, we can make condensed milk. So what we want to do in this case is that we want to talk about whether we want to process cream and skim milk further to cottage cheese or condensed milk, or maybe we want to sell the cream and skim milk as they are. In this case, we also think about the common process which we incur to make the cream and the skim milk so far. Actually, the joint cost which happened already is what happened already in the past. It doesn't change and it has no effect on the future and the present. So it is sunk cost. So even though I provide you some information regarding the common process cost, we don't want to care about it when we adopt incremental analysis. If I ask you to do the CBP, or maybe if I ask you to the ABC analysis, maybe you want to care about it. But in the case of incremental analysis, we don't want to care about it. Why? Because it is sunk cost, which has already happened. It is not relevant cost to the decision of making further processing or not. So regarding the cream case, the joint cost allocated to the cream is 9,000, and cost to process cream into the cottage cheese is 10,000. The revenue part, this cream, is 19. Cottage cheese is 27. So we want to care about only three things. We want to use three information over here because we don't want to care about joint cost allocated to the cream. Why? It is a sunk cost. So we want to compare which is the revenue in different scenario to sell the cottage cheese or the cream, and how much price, how much cost we need to pay to process the cream to the cottage cheese and the further process. So the increment analysis is quite simple. So sales per day regarding at the cream itself is only 19, but we don't incur any more cost. We process it further. The cottage cheese will be sold at 27, so we make 8,000 more sales. At the same time, we increase the cost, so we need to pay 10,000 more cost to incur it. So we lose 2,000 more by processing. So in this case, we should not process the cream further. Why? To sell the cream by as a stage it is better, is more profitable than process it further to cottage cheese. Even though we make more money by selling it, at the same time we lose more money by processing. So in total, by net income will be decreased because the processing cost is greater than the difference between the sales revenue. Now, how about the case of skim milk? We want to sell the skim milk as it is, or do we want to process it more further to the condensed milk? Also, in this case, joint cost allocated to skim milk is what we want to ignore to solve the problem because it's sunk cost. It doesn't change our decision. What we want to care about is $8,000 of cost to process skim milk into condensed milk, and $11,000 and $26,000 of skim milk and condensed milk revenue if we can make. So if we want to apply the incremental analysis, if we sell the skim milk as it is, we may make 11,000 sales revenue per day. We don't incur any more costs. But if we process it, we make 26,000 and we incur 8,000. Our revenue will be 18 compared to 11. So we make 7,000 more revenue. In this case of skim milk, we want to process it further. So we should process it to the condensed milk to make more revenue. So increase our net income. Is it easy, isn't it? The decision rule is sell a process for decision, process further as long as the incremental revenue and the processing exceed what? A, B, C, D. Which one? Do you think? So it is A. So if we compare only incremental processing cost and then which is relevant portion, which changes by different scenario by processing it, and the revenue incremental analysis. So incremental revenue and incremental processing cost, we compare those. If incremental revenue is greater, which it exceeds incremental processing cost, it means that we make more net income by processing. So in that case, we need to make more further process. If it's not the case, we need to stop it, the procession, and then we sell it as the stage as it is now. So I will give you 5 minutes to do this problem and we'll go together. So stop the video over here and then do it by yourself and then resume it after 5 minutes. Okay, now assume that you already done it. So Easy does it manufactures unpainted furniture for the do-it-yourself DIY market. It currently sells a child's rocking chair for $25. Production costs are $12 and $8 fixed. Each does it is considering painting the rocking chair and selling it for $35. Variable costs to paint each chair are expected to be $9, and the fixed costs are to be expected to be $2. Prepare an analysis showing whether Easy does it should sell unpainted or painted chair. So this is a question regarding the processing the painting or not. So to compare those revenue, because when they process it and paint it, they sell the painted one, they can make 35 instead of 25. When they sell unpainted one, they make $10 more by revenue section. Regarding variable cost, they for $9 more, so they lose $9 by selling the painted one only regarding the variable cost. In the fixed cost, actually they for $2 more. So when they sell the painted one instead of unpainted one, they make $10 more by selling it, but they also need to incur $11 more from variable and fixed cost, so they lose $1. Why? Because increased incremental processing cost is 11, incremental revenue is 10, so incremental processing cost is greater than incremental revenue. They lose $1. So in this case, their net income is greater when they sell the unpainted one, so they should not process the painting, and they should sell the unpainted one. Got it? Plotting up to 5, the scenario 4. Analyze relevant costs to be considered in repairing, retaining, or replacing equipment. So I'll give you 5 minutes to read this question, and then we'll go together. So pause the recording now and read it, and then resume it when you finish the reading the question. Okay, I assume that you finished the reading. The Jepcot company is considering replacing a factory machine with a new machine. Jepcot company has a factory machine that originally cost $110,000. It has a balance in accumulated depreciation of $70,000, so its book value is $40,000. It has a remaining useful life of 4 years. The company is considering replacing this machine with a new machine. A new machine is available that costs $120,000. It is expected to have zero salvage value at the end of its 4 years useful life. If the new machine is acquired, variable manufacturing costs are expected to decrease from the $160,000 to $125,000, and the old unit could be sold for $5,000. The incremental analysis for the 4-year period is as follows. Okay, now we want to know about which one is better. Keep the old one and fix it, and keeping it or buying a new one. Okay, first one, if we keep the old one, what we incur is that we need to pay $160,000 of manufacturing variable cost by each year, and we have 4-year period. So 160 times 4 is 48,000 regarding variable manufacturing cost. Is the only cost we need to incur by keeping the old one. Why we do not care about the original cost we paid and the cumulative depreciation and the book value? Because no matter what happened, maybe when we sell it, we need to make a journal entry in the financial accounting parts to keep the records of it. But in the management accounting parts, we only care about incremental analysis. This is some cost that already happened. We don't want to care about it. Why we don't care about it? What will happen by making different choices? Because even though what choices we make, there's no difference in how much we paid, how much we already depreciate, so we don't care about it much. Replacement equipment, if we buy a new one, we pay $500,000. Also, the new machine cost is $120,000. Why we pay $500,000 by bare manufacturing cost? Because if we buy a new one, we pay only $125,000 per year. We can reduce it by each year for 4 years. We can make only $500,000 of manufacturing cost, but we need to pay to buy. And when we buy the new one, we can sell the old one at 5,000. The total cost we need to incur by replacing is 615,000 compared to 640,000 retaining the equipment, the old one. So net income change will be 25,000 increase when we got a new one. So in this case, we need to replace it and buy a new one. What you need to keep in your mind when you're cautious is that we need to be cautious not to care about the historical cost of cumulative depreciation of the old machine. We only care about how much we can get when we sell it because it is the opportunity cost, or maybe the difference what we make. So we only care about what difference will happen when we choosing by different two options. So in the financial accounting parts, when you sell the old machine, you may reduce the cumulative depreciation to cancel it out. And we need to determine how much revenue, the benefit, how much loss or gain we make. But in the manager accounting, when we apply the incremental analysis, we only care about what changes, what difference we make by choosing different options. Make sense? We don't want to care about the sunk cost. We only care about relevant costs, and also we care about the opportunity cost we make. So in this case, additional consideration, which is that I already talked about how much the book value of the machine we have. It does not matter because it's sunk cost. But however, we want to care about how much trade-in, how much cash disclosure, like a 5,000 over here, how much we make when we sell it. Okay, I will give you guys 5 minutes to read this question and do this question. So, and then we'll go together. So stop the recording now, 5 minutes, maybe more, as much as you need. Read it, do it, and resume the recording. Okay, I think you're like done. So Rochester Ripping is faced with the decision. The company relies very heavily on the use of its 60-foot extension lift for work on large homes and commercial properties. Last year, the company spent $60,000 refurbishing the lift. It has just determined that another $40,000 repair work is required. Alternatively, Rochester Roofing has found a newer used lift that is for sale for $170,000. The company estimates that both the old and new lift would have useful life of 6 years. However, the lift is more efficient and would reduce operating expense by about $20,000 per year. The company there's a land out a new lift for about $2,000 per year. The old lift is not suitable for long-term. The old lift could currently be sold for $25,000 if the new lift is purchased, prepare an incremental analysis. It shows whether the company should repair or replace the equipment. Okay, it's not simple, right? If we retain the equipment, we need to incur for $20,000 per year, so we can use it 6 years. So it'll give you $120,000. Repair cost we need to incur if we keep the old one is $40,000. The total cost will be $160,000. But if we replace it, actually, what we do is that we need to make a rental revenue because we can renter it for $2,000 for 6 years. In a new machine, we need to pay to buy, and also we can sell the old one, $25,000. So in this case, what we do is that we can only incur $135,000 if we buy a new one. So we can increase our net income. By the way, this number is somewhat different, I think. How could it be there's 27 difference between 160 and 135? Let me see, maybe there's one. Sorry about that. Let me see. Okay. 170, new left, makes sense. Reduce repairing, okay, 20,000. And also repair cost 2,000. Rent one makes sense. View machine cost. Okay, pull sales of all the machine. So let me see if it makes sense or not. 27 or not. So I'll use my calculator. If you do it by yourself also. 170 plus minus 20. 170 minus 25. It should be 133, right? So there's something wrong with that one. Was one way over here. Sorry. So what I mean. So the total cost for replacement equipment should be 133, not 135. So in that case, so we can increase our net income by replacing it. So 27,000. So in this case, we should replace it. So I mean that there is typo replacement equipment's total cost should be 133, not 135. Make sense? Okay, the last scenario, the longitude 6, the scenario 5, analyze relevant cost in deciding whether to eliminate an unprofitable segments or product. So we need to focus on relevant costs. So we need to think about whether the unprofitable segment could be observed by other segment, or which means that it can decrease our fixed cost or not. So the decision rule is that we need to retain the segment unless the fixed cost eliminated exceed the contribution margin loss. So this is simple. You can think about if a company makes 3 different products, and Pro, Master, and Champ looks unprofitable. Why? Because its sales revenue is less than the variable and fixed cost. So the net income is minus 20,000 in the Champ. We need to eliminate that one. If we think that if we eliminate the Champ product line, if we reduce all the 20,000 of the net income negative effect, we should do that. But do you think that we can reduce all the fixed costs if we reduce it, or maybe we need to assign the fixed costs to either Pro and Master and we don't make revenue? So which one is better? Okay, if we eliminate the Pro and Champ, and if we need to assign the fixed cost, we can reduce it or decrease it. We need to just allocate it to Pro and Master, to 2/3 and 1/3 to the Pro and Master. So it will increase the fixed cost of Pro and Master. Actually, it will decrease our total net income 10,000. Before, we could make some revenue by producing Champ, so our total net income was 20,000. Now, by reducing and eliminating Champ, our total net income will be 210. So actually, our total net income is decreased by 10,000 by eliminating, which is unprofitable product line, because we need to care about which one is better to make it. That's why we need to perform the incremental analysis, just intuitively eliminate unprofitable product line. So we can just apply the incremental analysis only for the Champ. If we continue keep producing it, we make sales of 100,000, variable cost is 90, contribution margin is 10, fixed cost is 30. So net income is negative 20, but if we eliminate that one, we don't make any sales, and variable cost is 0, also contribution margin is 0, but we still keep our fixed cost as 30,000, so we lose 30,000. But when we eliminate that line, we lose 10,000 more, so net income will be decreased 10,000 more. So even though the Champ product line lose money, it is better to keep it, unless we can get rid of all the fixed costs together. So assume that 22,000 fixed costs could be reduced. So now if we eliminate the product line of Champ, we only incur 8,000 of fixed costs. In this case, actually eliminating Champ product line will be better because it will provide us 12,000 more net income when we eliminate that one compared to the continued production of the Champ product line. Got it? The question is that if an unprofitable segment is eliminated, in which cases? The answer is C. The fixed expense allocated to the eliminated segment will have to be absorbed by the other segment. which means that when we eliminate the unprofitable segments, if we cannot reduce all the fixed costs, we need to observe the fixed costs to other product line we keep produce. So we need to compare whether the fixed cost expense allocated to other lines are better or not. So we need to perform and apply the incremental analysis before we just get rid of unprofitable product line. So for example, this reality example, whether the company use incremental analysis, whether they want to do, okay, already time to move to a new neighborhood. If you have ever moved, then you know how complicated and costly it can be. Now consider what it would be like for a manufacturing company with 260 employees and a 170,000 square foot facility to move from the Southern California to Idaho. That is what Buck Knives did in order to save his company from financial ruin. Electricity rates in Idaho were half those in California. Workers' compensation was 1/3 the cost, and factory wages were 20% lower. Combined, this would reduce manufacturing costs by $600,000 per year. Moving the factory would cost about $8.5 million plus $4 million to move key employees. Offsetting this cost was the estimated $11 million selling price of the California property. Based on this estimate, the move would pay for itself in 3 years. So now what they do is that they apply the incremental analysis in the reality. What happened is that ultimately the company received only $7.5 million for its California property. Only 58 of 75 key employees were willing to move. Construction was delayed by a year, which caused the new plant to be increased in price by $1.5 million. And the wage surged in Idaho due to low unemployment. But despite all of these complications, the company considered the move a great success. So we learn in the class is what we exactly use in the reality. So that is why important is we learn about accounting. So do the problem. I will give 5 minutes to solve this problem, and then we'll go over it together. So pause the recording and do it for yourself. Read the question, and then we'll go over it together. Okay, I assume that you already did it. 5 minute pause and solve the problem. So now we want to go together. Lambert Incorporation manufactures several types of accessories. For the year, the knit hats and scarves line has sales of $400,000, variable expenses of $310,000, and fixed expense of $120,000. Therefore, the knit hats and scarves line had a net loss of $30,000. If Lambert eliminates the knit hats and scarf line, $20,000 of fixed costs will remain. Prepare an analysis of showing whether the company should eliminate the knit hats and scarf line or not. Okay, if they eliminate, they will not make any sales. So the sales will be zero, variable cost will be zero, so contribution margin will be zero. And the fixed cost, they should have also $20,000, even though they don't keep producing, they eliminate the product line. So their total net income will be only negative $20,000 instead of negative $30,000. So if we compare one by one in total, they will make 10,000 less loss, so they are 10,000 more profitable. So in this case, they should discard and they should eliminate this product line. So this is what we covered today. So this is about chapter 20, and maybe tomorrow or the day after tomorrow, I will upload chapter 21 video recording. So please read chapter 21 also before to watch chapter 21, and then you can go over. And I will upload the homework problem for chapter 20 and the key for assigned homework for chapter 20. Just do it. If you have any further question, if you need any more help, we can maybe have a time to set to help each other together. So please watch this video. If you need more time, you can review it again. So let me know if there's anything I can help you more. So thanks for watching this video. Thank you. And this is it.